and I'll be taking you through an overview of finances and reporting. I'll just quickly share my slides, which hopefully everyone can now see. Andy, can you just confirm you can see those?
Yeah, I can see those.
Brilliant. So yeah, as Andy said, I am a director at Scrum Bland of our business advisory and software advisory department, which also covers cloud accounting. I've been a director at Scrum Bland for a year and a half now, and before that I've worked in different accounting firms, but always with a bit of a specialism in software, and mostly in growing and small businesses. So hopefully my insights and expertise are useful for you today. So the key things I want to be touching on first are reporting. So there are three main reports from a financial perspective that you'll need to have a good understanding on for running your business. And those are the ones listed on the left, which are cash flow, profit and loss, and balance sheet. Really, to fully understand how your business is operating, these are the three that you need a good understanding of how they work and the key figures inside them. And I'll come into those in more detail in a bit. But in addition to those reports, there are three things that you should also be looking at. The first one is what's referred to as key performance indicators. It's really a long title for the key things that you need to look out for in your finances. These could be as simple as how your revenue is performing. So it could be revenue increase year on year. It could be what your gross profit margin is, which is your turnover less your cost of sales to make your gross profit, and that is then divided by your turnover to make your gross profit margin, or just what your net profits, your takings, are going to be on a year-in-year basis. These are really kind of tailored to how you operate your business. So you've got some generic ones, some of the ones I've covered, and then you've got ones that are more specific for how you run. These could be, especially if you're web-based, active customer numbers, so who's accessing your product on a daily or monthly basis, or delivery times, if you are such as Amazon and having to distribute quickly. Really, anything that is key for how your business performs is something that you should set as a key performance indicator, and then your finances should really be built around showing how those indicators are performing for you. The next area is something that you should make sure you have, which is a forecast. The general areas that you'd forecast on are cash flow and profit and loss, and I'll touch on these in a bit. And then something that you can achieve with certain reporting tools nowadays is a dashboard. A dashboard is really bringing the key figures to your attention. Mostly you'd want to focus on your key performance indicators, but it can also be other things that you want to focus on in the short term, such as potentially a marketing spend or when your tax is due to be paid. So jumping into reports, the first one I'm going to touch on is a cash flow statement. Now, cash flow statements are a statutory requirement on large businesses, and you've got an example on the right-hand side there. Personally, I don't find these that helpful. I work in finance, I see them all the time, and I still don't think they're that useful. They are a requirement, but not something that you really look at on a day-to-day basis to help you run your business. They're quite complex in how they're structured. They're supposed to be broken down into multiple areas, allowing you to focus on how the business is performed in those areas, such as your operating activities, which is your daily trade. And then you're investing, how much you're spending to invest in long term in the business, such as asset purchases. And then financing, funds in, such as loans, and funds out, which are distributions. And that will come down to your net cash in or out for the year. Apart from the operating part, they are not trade related. They don't really help you forecast. And so this is a limited report in its sense. It's more of a historical report. And if you're a small or growing business, it's not something I would really focus on. Instead, I would look at a generic cash flow report. Now, this is really perfect for cash flow forecasting. You look at your inflows at the top and your outflows at the bottom to show what your net cash flow will be in any given period. This could be monthly, daily, quarterly, annually, whatever you want to report on. It really is as you desire. But the key thing is this is actually based on your payments and your receipts. It is not based on invoice dates. It is as you'd expect money to come out of your business and come into it. Now, this is incredibly important, probably the most important report that you can have, especially early on in your trade, as the key saying is cash is king. With no cash, you cannot pay for anything, and therefore your business will stall or completely fail. So cash flow reporting and cash flow projecting is probably the most important thing you should do. Make it as simple as you can, because as long as you have the detail, you can see where you're spending money on, so you can make your business decisions on the fly. It'll be much more tangible for you. You don't want to overcomplicate this report. It's also very good, as I mentioned, for forecasting, but budgeting. Now, there is a slight difference between a budget and a forecast. Budget is obviously something that you're trying to attain, where a forecast is more what you expect to be a result. And a forecast can work on cash, and you can tweak your trading terms with your customers and your suppliers to manipulate your expected cash flow. So if you believe you will go into the red at some point, which is very likely to happen at an early stage business, you can agree to defer some payments with your suppliers and try and drag some money in from your customers to balance that fund, or potentially look at additional investment. Then we come on to the more statutory reports, such as a profit and loss account. So profit and loss is basically just taking the cash flow and bringing it into invoice terms. So it matches the trade you're performing to the period that trade relates to. So if you've delivered something, but you are not receiving the funds for that for a while, then your profit and loss will reflect that income, but your cash flow won't. That'll be deferred into a later period. So your profit and loss, as simple as it is showing the profitability of your business at any given time. The right-hand side is an example of profit and loss under what's called FRS 102, which is what small businesses have to report under, small companies have to report under. There are multiple different ways of presenting a profit and loss, especially if you're a sole trader or in a partnership. And you can break this down into more detail to make it easier for you. Something that generally is broken down would be your cost of sales and your administrative expenses. These are obviously your day-to-day expenses and help you understand how the business is operating and making either a profit or a loss. The other key figure on the profit and loss is the tax. Now, something that we find in accounting firms, especially for early businesses, is they are not keeping track of what the tax liability is, the tax on their profit. And so when it comes to actually having to pay for it, they do not have enough funds in the bank. So this makes it very important that you are understanding both your cash flow and your profit and loss report. Now, some of these can be built in to the more advanced or modern software to run automatically with an estimate of tax. And you can use this to then build it into your cash flow forecast to make sure you have sufficient money in the bank for when it's due. The other area that a profit and loss is very important for, especially for limited companies, is for drawings. So you can, in essence, take money out of your business as long as you have it in the bank. But from a legal perspective, you are only allowed to withdraw the funds that you've earned as a profitable in your business after tax. Now, if there is quite a difference between when cash leaves your business and cash comes into your business compared to when you're earning the profit on it, i.e. when you've delivered the trade and the expenses relate to, the period the expenses relate to, then there can be quite a difference between the funds that are in your bank and actually what are called distributable funds, which is your profit to date. So if you want to make sure that you are not withdrawing too much out of your business too early on, you need to make sure you keep on top of your profit for the year. Key for the first year. In later years, then you need to add up your profit to date, which I'll come on to in the balance sheet for a key figure to look at in that area. The profit and loss is also key for obtaining finance. This is what your, I guess, your lenders, be that bank or external lender, would look to for establishing whether you, I guess, the amount of funds that they would look to lend to you. So this is either when you're forecasting into the future to establish how much lending or funding you can achieve now, or historically to agree trading terms for potential invoice discount or invoice funding. Moving on to the balance sheet. On the left is an example of a balance sheet under FRS 102. This is, I guess, probably more complicated than some that you may have seen, but it's broken down into a few key areas. Firstly, a balance sheet is only ever reporting at a fixed date. Profit and loss reports over a period, and you can widen or narrow that period to report either on a month or a day or a year. But a balance sheet is only ever given at a fixed date, and so it's always technically out of date unless you're looking at it at that second and you're working in live finance. On that basis, it's good to understand, therefore, the snapshot of the business at any given period. But it's not great for understanding where you are now. And so that's where the dashboards or the forecasts that I was discussing earlier are more helpful. Key figures on the balance sheet be fixed assets. These are items that you have paid for in advance but will last you multiple periods. And most of those, I guess, early on would be computer equipment based on what you work in. Potentially, you can also include website development in there or software development that can be built into your fixed assets. You'll have your current assets, be that stock if you're working in a commodity business, or your trade debtors, what is owed to you by your customers. And then, obviously, key one is cash at bank. Key area you always want to look at is what your current assets are compared to your current liabilities, which would be your creditors' amounts falling due within 1 year. This forms what is known as your net current assets. If your current assets are greater than your current liabilities, you can always pay your liabilities as they fall due. If that is not the case, then you are reliant on your fixed assets and or the terms of your creditors. If you need 9 months, for example, corporation tax to pay your tax, and you do not have sufficient money in the bank, you will need to make future sales in order to and get more money in over time in order to pay those liabilities as they fall due. So net current assets is a key figure on your balance sheet. The other area would be net assets further down, and this is what's used to derive the value of your business at any given time. Part of the forecasting, if you're looking at cash flow or profit and loss, is also to forecast what your net asset position would be as your business grows. This is used to via a multiplier, which is usually a 3 or 4 times multiplier to give you a total value of your business. I also mentioned about cash withdrawals or dividends from your business, and the key area that you want to look at is in your capital reserves, be that your profit and loss account. The total balance in your profit and loss account at any given time is the total amount that can be withdrawn at that point via dividends legally. You can withdraw in excess of that, but these are classed as illegal dividends, and if the business was to fail, can be clawed back off the directors in order to satisfy any outstanding liabilities. So always be careful in establishing how much to draw out of the business, what your profit and loss account is at any time. So that was a summary of the key reports. But another key area is the record keeping for any business. There's multiple different ways of keeping records, as shown on the screen. Generally, the historical way would have been manual, writing up manual ledgers, painful and slow way of keeping any records, and as of I guess today, is now not compliant with legal requirements, especially if you're VAT registered. If you're not VAT registered, you can get away with keeping manual records, but only for the time being. As you must see, bringing in a system called Making Tax Digital, that future implementation plans means every single business will need to keep digital records. So if you are keeping manual records at present, please don't. I'd advise switching to a digital format. This can be as simple as Excel and Excel spreadsheets. I'd say it's simple in the fact that it's very easy to set up. as long as you understand Excel, you can keep records, and those will be compliant from a company's house and HMRC perspective if you are a company. But it's very hard to get any sensible information out of these. You have to build some complex rules into your spreadsheet to get anything out. And it's also generally quite historical. It means that you need to find time to type these up. And so what businesses have moved towards is software, specific finance software. Historically, this would always be desktop or server-based software, but there's a lot of manual entry involved in those, and so businesses are switching over to something called or cloud, or something that we refer to as cloud accounting software, which I'll give some examples of. The main benefit of this is most of them are created to satisfy business owners rather than accountants. A lot of desktop software has been written for accountants. There's a lot of complex terminology in there, whereas cloud software has been simplified, assuming that you're using the right tools. There's probably some complex cloud accounting software out there, but I will go through some of these in a minute. The other main benefit is you can integrate this into other software, such as your CRM and your operational software, to automate some of the processes. So jumping into some of the, I guess, more well-known cloud accounting platforms, the key ones that we tend to work with at Scott & Bland are shown on the screen, with Xero being the one that we tend to prefer. Now, picking the right cloud software for your business comes down to actually what you want to do and where you see your business developing. If you want to grow, you want to make sure that you have adopted a finance software that enables that growth, because otherwise you're going to have to transition from one software to another, and that's quite complex and can be quite costly. So we always advise, look at where you're going to be in 3 to 4 years' time, and make sure you are adopting software that's fit for your business in that time period. Now, Cashflow is a very simple cloud accounting finance package, very easy to use, but will not enable growth upwards. Sage Business Cloud. Sage has been brilliant as a desktop software, but in reality, its cloud software has fallen behind some of its competitors, and those are QuickBooks and Xero. QuickBooks and Xero are very comparable. We tend to prefer Xero at Scott & Bland purely for 3 reasons. One, we find it to be one of the most secure. It has very good security protocols in there, especially if you adopt the highest level, which means it's very hard for anyone to hack your software, which with GDPR it can be very important, especially if you get to the point of hiring employees and you use payroll software. You want to make sure that you have high security enabled. It's very fast, so if you don't have the best broadband speeds, always advise using a fast software provider, and it enables growth. It has a very good API to build into, and you can build bespoke integrations into it or use already built integrations. The other software we've got on here is Exact. Exact is the leading cloud finance software in Northern Europe, and is very powerful. It's probably a level above Xero in, I guess, the number of transactions it can deal with, but it's also slightly more complex. So we find for the majority of our businesses, which are anything from turnover 100,000 up to 10 million, we find Xero hits the sweet spot in that area. As I mentioned, the likes of cloud finance software also integrates into operational CRM, industry-specific software. We've got a number of these listed on the screen now, but in reality, there is over 800 apps that integrate with Xero. And so what we are doing with our clients is helping them build an ecosystem of software, operational, finance, that work all together and share information. So you have a single complete data set that enables a flow of data from one area into the other. It massively reduces data entry, enables trust in the figures you're looking at, and also efficiency. So if you want to grow, you'll want to look into building an app ecosystem that integrates into your finance software. Just in case you've not come across any of these before, first ones I'd advise always looking at is Receipt Bank. This is a brilliant tool for entering your expense invoices. You literally take a picture or forward an email if you receive your expenses via email, and that tool will scan all that information and push it into your finance software ready for payment. Another good one is, especially if you've got credit terms for your customer or customers, is Chaser. This is an automatic debt collection tool. So it creates email chasing or emails that chase your customers, but in a human tone. So they're written in a way that makes it sound like it's coming from you and enables you to escalate that over time. So maybe after 7 days after your terms, you want it sounding like it's coming from yourself in a nice way, but maybe after 30, 40 days after terms, you want it to sound like it's coming from your solicitor. Chaser enables you to build that in automatically, so you can just let it run in the background, and it's proven to improve cash flow by how it operates. So what I've put on screen now is an example of the likes of the systems that we help build, and you can build yourself. This is quite a complex one, but I'll just talk you through some of what the apps or these programs are doing. So Xero sits in the middle as like a single data set of truth. It is the finance package, but also works very well at just capturing certain other information. Receipt Bank is the tool that captures your purchase or expenses, and then Approval Max is basically a tool that, if you are a bigger business that's got multiple people and they're kind of dispersed, works very well in distributing those expense invoices to key people that can approve them. This works very well in project management, especially if you've got people that are doing the procurement, but you want oversight into what they're buying. Deputy is a staff management tool, very good for clocking in, clocking out, and for managing timesheets, etc. Not quite HR. It's got some very basic HR tools, but it's very good for staff management otherwise. On the left-hand side, Shopify and Sin7, very good for online sales portals and stock management. 9 Spokes is an example of a reporting dashboard that can take information not only from Xero, but from Deputy, Sin7 and Shopify to bring it all into one data set to show you the key information that you need to see, not only on your finances, but also in your operation and maybe on your marketing. See how well people are engaging with your website or your sales channels. You can see that on a dashboard, literally on your phone. I thought I'd also touch on some of the key requirements that you need and to be aware of when running and operating a business. We find a lot of clients when they set up, it's quite overwhelming, especially from a statutory and regulatory point of view. So I thought I'd run through some of these key things that you need to be aware of. First one as a company is your registered office. This is where all key correspondence will go to and what is shown on public record. Now, some businesses prefer that to be their own office, and some like that to be their accountant or their advisor. In reality, it's completely up to you. You can pick what works for you. We find for most of our clients, we act as a registered office because it enables us to filter through anything that is really not that helpful from a business point of view, and keeps us abreast. And then we manage, I guess, the key dates, the key filing or reporting requirements on behalf of our businesses. Something worth talking through with your business advisor if you haven't already. The articles, which are, I guess, what governs how your business operates, how you need to work with your other shareholders, directors, stakeholders. You need to maintain those, and you probably have basic ones that are kept at Companies House from creation. Most businesses have just the standard operating articles, but something that you need to do on an annual basis is file a confirmation statement, which is confirming very basic elements about the articles, such as the directors, shareholdings, etc. Most of the time, you'll just be confirming that those are as they were in the previous year. This is something we operate for most of our clients, but you may find it's very easy to do yourself. As long as you've got your Companies House login, you can go in, check these, and then file it on an annual basis. As discussed, maintaining financial records is a legal requirement for any business. You need to make sure that you can report on your business finances at any given time as requested by HMRC or the state. So maintaining financial records is important. Make sure you're doing those and you're doing them as regularly. I always advise, as I said, using cloud accounting software because it just makes it easier, and you can do it in live, in real time. So you're looking at your finances as they are today or yesterday, rather than as they were a month ago, or if you're looking at statutory records, which require 9 months for filing, can be 9 months in arrears. So as I said, annual accounts, at least from a company perspective, need to be filed within 9 months of the year end date. That's unless you've got an extended period. So if you've got a period that's longer than 9 months, which would usually be longer than a year, 12 months, which is normally your first year, then it's, maths here, is 21 months after the end of the prior accounting period or the date of incorporation. Now, this does catch out a number of businesses in their first year, because what they're looking at is their year end and added on 9 months, not considering actually that we've got a longer period, which always happens if you're just going with what Companies House sets for the first year of accounts. Something else that needs to accommodate or comply with filing annual accounts is minutes to document what the directors are doing. Agreeing the accounts are correct and ready for filing, and any distributions, so any dividends, to make sure you are keeping minutes. You will be able to find a number of examples online, or talk to your advisor and they'll be able to provide examples if you want to do this yourself. A number of accountants will do this for you as part of their annual accounts process, but there are accountants that don't do this and don't discuss that with their clients. So they will file the accounts, you assume that the minutes are completed, but that hasn't been done. So make sure that you're seeing minutes that accompany your end of year accounts and any dividends you are issuing. In addition to annual accounts, you will have tax that comes with it, be that business tax, corporation tax, partnership tax. So if it is a limited company, there'll be a corporation tax return that needs to be completed in combination with your annual accounts. And if it is a sole trader that you're running or a partnership, you'll need to complete a personal tax return. The requirements for tax are, at least if it's a company, is 9 months and 1 day after your year end, unless it's an extended period, and then it works in the same way as the annual accounts for filing dates. But oddly, the tax return can be filed 3 months later, can be filed 12 months after your year end. Generally, you'll have your tax return filed at the same time as you're making payment or in advance if you're on top of this. But yeah, there's a bit of an anomaly in reporting there in the fact you can file it later. Insurance. I want to cover a bit of this because it's something that businesses can miss when setting up, but is very important. There's a few that are worth touching on. Public liability is probably the most important, but it's worth having a discussion with an insurance advisor, especially if you're setting up for the first time, to make sure that you're getting the right insurance for your business. There are a few, depending on how you operate, that you should be looking at. Public liability is one. It's generally not the most expensive depending on what sector you're involved in. If you're involved in construction, public liability can be very expensive, but if you're working on IT, it can be a lot smaller. Employers' liability is key if you start bringing in staff, and professional indemnity is important if you provide professional services. Something that is becoming more popular now, that is probably key for if you're working on software, would be cybersecurity. So insurance. So if you are keeping data, I guess, locked on your servers, and that could be data from a GDPR perspective, then it's worth looking into cybersecurity insurance. Something that we can help with at Scott & Bland. Not all insurance providers do provide this, although it's becoming more popular now, but it's worth getting the right one for how you operate. It's quite a bespoke area at the moment, so definitely dig around in this if it's something you think will be important for you. And then another area that is usually missed when businesses set up are stationery requirements. Now, this sounds a bit odd in its terminology, but actually just means information you need to put on any correspondence you're having when it's on in regard to your business. So any emails, any letters, any invoices that you send out all need to include certain information about your business, especially if you're a company. This is company number, the registered office address, which if you don't want to be sharing your business address means that you should have potentially consider having a registered office outside, either maybe your advisor or your accountant. Your company name, i.e. the one that's lodged at Companies House. yeah, and as I said, these need to be on invoices, emails, and any correspondence such as letters that you are working. If you use faxes, you need to include it on that as well. So I just wanted to touch on the end is funding, and I think this is more because of what's happening at present. Obviously, there's quite a squeeze on businesses at the moment, so lots of businesses need to look into potential funding. If you are setting out, it's maybe something you've done already, but obviously there's many different sources for this. Overdraft being the simplest one, generally to get set up. Depending on how responsive your bank is at the moment, the overdraft might be something that you should get set up straight away. And then normally the next one that's easiest to set up is a term loan. This is what I refer to as external financing, so either from a bank or another source, angel, if they're loaning something in, or potentially family members. Term loans obviously work for a period and usually have interest on them, although sometimes you can work with interest-free loans, and that has a different effect on your profit and loss. If you're working as a company, you still need to reflect an interest amount in your business, even if it's an interest-free loan, to talk to your advisor about how you do that. Invoice finance, if you are issuing invoices which have credit terms, invoice finance is usually a relatively quick thing to set up, and would, in today's market, is probably a good thing to go for. It's probably going to be quicker to achieve than a term loan. So anything where you are working purely in the UK is what's deemed relatively simple invoice finance, and I can provide some lenders that potentially help you in that area. But alternative to all of that is equity funding. So as I said, angel investors. Now the balancing act between term loans and equity is about how you want to report and how you want to extract finance out your business in the longer term. So obviously equity means that as your business becomes more profitable, your equity investors will get part of that, but you may get benefits early on in a large value of funding for relatively little cost to yourself. It just means in the long term, if you are profitable, you will suffer by having to pay money across to those, and it's hard to escape from that without selling the business, which obviously stops you reaping the rewards in the long term. So balancing between the short-term costs of a term loan or invoice finance against the long-term costs of equity funding is something that's worth considering, and you probably want to do some forecasting with your advisor to make sure you are getting the right balance in that. My advice to most of my clients is, if you can afford going down a term loan and you've got the confidence in the business, go for that aspect rather than equity funding. I find a lot of clients 4 or 5 years in will struggle with the fact that they have an investor who is getting money for them doing all the work, which is what you will get if you go down the equity funding route. Doesn't mean it's bad. It can be brilliant in growing your business quickly, but it's something worth looking at. And then the simplest form is the director's loan account, which is literally you putting money in to help finance the business yourself. If you are working and getting help from your family, that's something to consider. We tend to find that if you are operating your business as you operate your personal finances, the director's loan account becomes a bit of a blur with lots of transactions. My advice: always keep your business finances very separate from your personal. Draw down from your business into your personal account and only use your personal account for personal finances. Try to avoid using your business account for personal finances wherever possible. It just really complicates your internal financial reporting and makes it a lot harder to see where your business is at present and where it's going to be in the future. So that's my overview. I think I saw some questions pop up as I was talking through, as well as obviously this the question and answer session. If you have any questions at any point, please feel free to drop me an email at ryan.piercy@scruttonbland.co.uk. And if you've got any questions on what's going on with COVID-19 finance, because it's changing on a daily basis, what's happening in job retention scheme or anything similar to that, please feel free to go to our website, which is www.scruttonbland.co.uk, and look into our specific COVID-19 fact sheet. We're recording videos, we're running seminars, and we are releasing articles daily pretty much, which is helping guide businesses as things change. Brilliant, thanks.
Okay, thank you very much for that, Ryan. I think that's sort of touched on a lot of the sort of general questions that we tend to get asked around finance and what's important to track and monitor. As you sort of said, I think there's a question in there, but I think sometimes, just to start with, it sometimes feels common that maybe people start out as sole traders and then they sort of move into being a limited company. And they don't always understand that transition. Is there any advice that the kind of our audience need to be aware of if they've started off in one form and they're looking to move into the next?
Yep. So firstly, it's not the most difficult transition to do. I'd always advise talking to your business advisor or accountant about doing it. But there is something called incorporation relief, which enables you to take all your assets in your trade from your sole trader and move that into a newly set up limited company without any tax detriment. If you don't go down that route of enabling corporation relief, then you'll be basically selling your trade from one business to another, and you will suffer tax on doing that. So it's something that you need to look at, consider, and make sure you are enabling the right selection on a tax return to make sure you get the benefit. In reality, there's different reasons for going into being a limited company over a sole trader. Two are the ones that we focus on. One is tax. If you are bigger than probably about £30,000 worth of income, then it's tax beneficial to be as a limited company and draw down dividends. Anything less than that, generally the additional costs for statutory requirements, so filing of a more complex set of accounts through Companies House and the confirmation statement, etc., those costs generally outweigh any tax benefits you've got. So £30,000 and above, and that's not your turnover, that's your profit. You'll want to be considering becoming a limited company. And then the other area is risk. If you're quite a risky business, I'd always advise becoming limited. You can basically house that risk in a different shell. It means they can't come after you for reparation of liabilities if the business does fail at any point.
Yeah, and I think you touched on a really important one, which is the insurance types that businesses need to consider as well. Always worth exploring those. We recognise that sometimes when you are bootstrapping, you may overlook something that you sort of deem as essential versus kind of delayed investment. We always recommend to exercise caution around those kind of areas and actually sort of say it's worth speaking to insurance brokers. But I think you kind of covered a few sort of quite nicely there. Obviously, we typically talk about public liability and professional indemnity. And I think you kind of touched on a really important one at the moment, which is also about cybersecurity now.
Yep.
And no one escapes this. It doesn't matter if you're a small student startup all the way up through. Things around GDPR apply to you regardless if you're handling personal information. And naturally, sort of during these times as well, there's been reports of increased cybersecurity. So if you are issues. So if you are trading at the moment and you're concerned about that, it is worth looking at. And they're not always expensive options. That's something to factor in as well. And sometimes that cost up front is worth the investment much further down the line. So we always recommend that you exercise those opportunities. And really it is something we have to kind of say that from the moment you start trading, those things should be in place. And sometimes before.
Yeah, definitely. And I personally, on a personal side, generally avoid assurance. Not brilliant, just a personal choice. I take that risk in most areas of my life. But when it comes to business, I would not do that. Obviously, that's how I'm going to be generating income, and I want to make sure that my potential assets that I build up in my business as I grow are covered. So yeah, definitely advise looking into insurance.
Okay, so what we're going to do is we're going to jump into some of the questions. And first up from Stefan was, are the minutes required when there's only one director?
Yes, yes they are. It can seem absolute nonsense because you're basically signing something that you're aware of anyway, but yes, you need to maintain minutes. You can get away with doing minimal minutes. So you need to do an AGM every year, and really you just tie that in with your annual set of accounts, and they're very bland. So we basically, for the minutes we do for our clients, basically saying we agree to the finances that are in there, and if you have got dividends, we state that there's sufficient reserves to enable you to issue your dividends. The dividend minutes are actually incredibly important, and that's every time you withdraw funds. So if you're withdrawing funds on a regular basis, being that every month or half fortnightly or even potentially daily, then early on you can potentially get away with doing a dividend minute like for a quarter, and say that you are just drawing down in advance of that. Over time, we strongly advise trying to align your drawings with maybe every quarter, so you're drawing a fixed amount on a regular basis out of the business, and doing a dividend minute to support that. For small businesses, HMRC generally are quite lenient, especially in the first few years, but as you grow, they will look into your tax planning and will require or request you to provide dividend minutes supporting what you're doing. And if it looks like you are drawing funds that do not match that, they will penalise you from a tax perspective. So always make sure you are getting your dividend minutes drawn up. Once again, can be incredibly simple. If you get a pro forma, you can complete those yourself as and when you withdraw money from the business.
So, and we've got one here which was a question about clarifying, could app development fall under fixed assets, do you think?
Yes, it can. So this is actually a change in legislation 3-4 years ago, which enables you to capitalise your development costs. You can only do this under certain criteria, and so as any costs that you incur in researching how the app will look, researching the customer base in which you're going to be I guess delivering this asset to, those cannot be capitalized, those are going to be expensed. But the actual coding of like the app and I guess getting to a point in which you're ready to deliver it, those can be capitalized and then amortized over the period that you expect to get revenue from it. Now, how you do that is very complex, and so it's worth working with an advisor on how you do it, because there's certain things you're allowed in there and certain things you're not, and sometimes it may not be beneficial to do so from a tax perspective. So before you get to that point, I always advise segregating your reporting, so it's very easy to see what your app development costs are, and then discuss that with your advisor.
So, and I think just sort of also coming back onto tax quickly before I go on to one final question I think we've had from Marcus is also this sort of the personal allowance that people are permitted as sole traders.
Yep.
I think kind of the one thing I'll say about the government's making tax digital is that I run a small business on the side as well. I don't think there are any excuses not to do your return. It took me all of about 25-30 minutes, I think, but it's often seen as this huge mountain, and I think sometimes that can also be because you haven't necessarily kept on top of how you track your finances as well. So I think really it's more, again, some conversations we've had are around when payments are either cash and should they be issuing receipts. Obviously you should be doing that. You need to be tracking everything coming in and everything going out. But your tax return doesn't have to be a scary process. As I sort of said, my experience was pretty quick. It probably took me slightly longer than it should have done because I had to go back through and find some historical information that I didn't have to hand. But really, again, it's just to say, you know, much like your insurance from day one, you should be tracking all of the important sort of information that you should, and you should be aware of what you're liable to have to pay if you haven't put a little side pot together for your tax payment as well, because there's nothing worse than getting to the end and realizing that you owe money that you don't have at that point in time. So again, more kind of a friendly reminder just to keep that in mind as you're running your business and you're starting to trade.
Definitely. I mean, I don't like you saying how simple it is, but
Well,
you're doing us out of work. But yeah, no, yeah, certain tax returns can be very simple to do, and it's worth exploring whether you are comfortable doing that yourself online. But the other thing is, if you can find an advisor that you're happy to talk to, that that can just give you some insights. So lots of people, I just have a quick chat with, give them some insights and things to consider. Then you can run your tax return yourself. With the knowledge of certain areas that maybe you can get some tax relief in.
So, okay, and we've got a question here from Marcus, which was, if someone's put money into a business to help set it up, either owner capital or director's loan, at the point when your business is making profit on its services or products, does returning those funds and only those amount count as taking drawings?
No. And you can take that money out at any point. So if you put money in, that's cast as a director's loan and sits as a credit. That amount is basically a liability owed from the business to you and can be withdrawn at any point, tax-free, up to obviously what's in there, what's owed to you. Something that I would consider doing as well is potentially charging interest on that loan that the company owes you, because you have a certain amount of interest you can receive annually, which is tax-free. And so if you are charging yourself interest from the company, you are increasing the amount that the business owes you, which we can withdraw in the future tax-free, but you're also receiving some income. Now, that doesn't need to necessarily be paid out. You can leave that in the business to be paid out later, but you are accruing that liability over time and increasing the amount you can take out your business tax-free as and when it starts making money.
Okay, so what we'll do is, if there's any questions, we'll give you a minute to send those through. Again, just want to really reiterate the point about the various software tools that Ryan's gone through. It's about doing your research, finding the one that's right for you. And sometimes in the earlier and more formative stages of starting a business, it's the right time to invest that extra time to actually look at how you create a lot more integration and automation in terms of how you make your business maybe leaner or more automated to benefit that going forward. And again, sometimes you're quick to get up and running as fast as you can, but sometimes just a small moment just to review additional options where the time invested now can be a much greater time saving in the future. It's always harder to sort of backwards engineer something into your business than it is to start with it up front. So,
Agree.
Daisy has asked, in follow-up to Marcus's question, what was your answer that you gave, Ryan? Sorry, related to a limited company or as a sole trader?
So was this the interest on director's loan account?
Yeah.
So that's a limited company. So you can't do that if you're a sole trader, because the limited company works as a separate entity. Sole trader, you are acting as yourself. So when you've got two separate entities, you can trade between those, and that's what that interest is. If you are acting just as yourself, unfortunately, you can't work that angle. Sorry, Andy, was there a question regarding personal allowance at some point? Was that?
No, I brought that up about personal allowance and making sure you understand what that is before you have to start putting money to one side for your tax.
Okay, so I'll just kind of pivot off that. And a benefit of going through a limited company is you can pay yourself a wage, which we usually work as tax advisors up to be at least or near to your personal allowance. The benefits of doing this is you contribute to your to the what's it called, the Department of Work and Pensions contributions. So you've got a year that contributes to that. You get it out tax-free out the business, but it's also tax deductible in the company. So you can offset it, and even if you're making losses, it can't be recalled. So if the business does fail, you're still managing to extract some funds out of the business. You don't need to wait until there's profits in there to do that. So that's something that we always advise, is even if you're operating as a limited company, put a small wage through your business up to your either your NI limit, which is around 8,800, I think, or the personal allowance is about 12,500, to get some funds out without any recourse on yourself.
So, okay, we just had one final question from Stefan. I think it's probably what we'll do is we'll draw it to a close after this, and then if you've got anything else, you can follow up with Ryan using the contact details on your screen. I suppose it's a bit of a personal opinion. What's your view on Zoho Books? It's a large platform with CRM and stock management. Do you have many clients using that, or any perspective on Zoho?
Zoho is okay. I'd say my understanding of how I've come across Zoho is it's very good in everything it does, but it doesn't specialize in any one area. So software historically used to be that, like take Sage as an example, is that they would buy other areas in order to expand, and so every bit of software was good, but they never focused on developing it any area to be as the best in its field. Whereas what's happening now is software is creating APIs, and so they'll focus on what they're really good at, and then they'll bolt into something that's also really good. So you can get the best of every field just by linking the products together via APIs. I think that's somewhere that Zoho maybe falls down on, is that they've tried to do a lot whilst not focusing specifically on one area.
So, okay, and I just want to say on that note, thank you very much to